This video is to promote my recent book, Super Profits and Cheap Stocks, The Secret World of Stocks that Sell from a penny a share to $10 a share. Now, there's no shortage of books about the stock market, but almost all of them involve blue chip investing. Rarely will you see a book dedicated to the world that nobody knows anything about, the secret world of stocks selling from a penny to $10 a share, and that's where I hang out at. Let me read the back cover to you. It says, Super Profits and Cheap Stocks, the secret world of stocks selling from a penny to $10 a share. The great stock market killings have always been made with cheap stocks that became expensive. For 57 years, I have made a career out of cheap stocks. I have prospered investing in the highest risk stocks that exist, the worst of the worst, microcaps, small caps, and penny stocks. In my world, you can only continue to speculate if you are successful. They drag losers out of the blood-stained arena floor where I live feet first. The ultimate proof that I have been a success is that I have written this book instead of living under a bridge. Let me introduce you to my world. I will show you how it is done. I will show you how to make a killing on a chump change investment. Where do I start? I start in the year 1968. I'm aboard the USS Little Rock, CLG-4, the flagship of the mighty Sixth Fleet in the Mediterranean. We are sailing somewhere off the west coast of Italy between Rome and Naples, and I am waiting to go on watch. I'm what was then called a radar operator, and which now is called an operations specialist. I was in the sleeping compartments waiting to go on watch when I happened to pick up a magazine that someone else in the crew had ordered. And in that I think it was Saiga, and in that magazine, it had a story about somebody who had made a killing investing in penny mining stocks in Canada. This, to me, was the most important thing in the world because I had been trying desperately for years to establish wealth, to establish financial independence through the stock market. And the problem was I was making about $360 a month then, and I was trying to buy stocks, blue chips, that were selling for $45 a share to $50 a share. And I just couldn't buy enough to move the needle. But this world that I knew nothing about, this world of penny mining stocks, I could afford to buy in volume. I could afford to diversify. And so this is the world that I have chosen. Let me explain to you how this world works, because it's something everyone can afford, because it's all about chump change investing. You invest chump change to make a killing. You diversify broadly, and I mean broadly. I currently own about 120, the last time I counted, I owned 123 positions. But you can afford to do that when you live in my world. Right here is the northern, so what I did is, after I read the article, the guy had put in the address of the northern miner, says, look, if you want to speculate in penny mining stocks, you have to invest in the northern miner, and the guy put the address down. If he hadn't put that address down, I never would have subscribed. So he had the address down. I subscribed to the Northern Miner, which is the Wall Street Journal of mining stocks. And I've been a subscriber since 1968. Right here is the front cover of the Northern Miner. It is like I said, it is the Wall Street Journal of the mining industry. It's been publishing since 1915. Now, let me show you the most important part, one of the most important parts of the Northern Miner newspaper, as soon as I manage to get it. Just a second here. So this is a weekly publication, and every week they have a page here called Market News, in which they give you what is happening in the Toronto Stock Exchange, the Toronto Venture Exchange, which is below that, and the New York stock and the U.S. markets. And I will show you what is so fascinating about this. How you can make a killing on a chump change investment. So this is the results for one single week. The senior stocks in Canada are called the Toronto Stock Exchange. Then they have the junior stocks below that. That's called the Toronto Stock Venture Exchange. So let me give you the results for 1 week. The results for 1 week, the 10 highest performing stocks. So in the latest week, the highest performing stock in the Toronto Venture Exchange, which is where all the junior mining stocks are, I don't even want to tell you what it is because it's so spectacular. In 1 week, it closed up, the high for the week was 31 cents a share, an increase in value of 1 week and 2,950 percent. 2,950% in 1 week. It is important to understand that you can buy stocks at less than a penny a share. You can buy stocks for less than a penny a share, at least in Canada you can. Let me show you the second highest winner. It was Cameco Mining. It closed at 19 cents a share, up 123%. That's the second highest performer. The third highest performer is Metal Corp, closed at 4 cents a share, also up 100%. Next one, Revalo Resources, closed at 1 penny a share, 2 cents a share, also up 100%. Then there was Revel Gold, closing at 4 cents a share, up 100%. And Alton Resources, closing at 1 cent a share, also up 100%. Pacific Silk, closing at 3 cents a share, up 100%. Up Anmark Resources, closing at 8 cents a share, up 87.5%. And the Rendawi Resources, closing at 10 cents a share, up 81%. And Sienna Resources, closing at 10 cents a share, up 77%. The 10 highest performers all went up at least 78% in one single week. Try getting that results on the New York Stock Exchange or in the world of blue chips. Try it. Now there's risk involved. Let's take a look at what the highest loser of the week was. The highest loser of the week was Silver Mountain Mines, down 66%. That's the highest loser. So there are losers. And when you play in my game, you have to understand something very clearly. No one is right in this racket more than 80% of the time. No one is right in this racket more than 80% of the time. Even Warren Buffett is not right more than 80% of the time. The gold standard is being right 60% to 80% of the time. That's the gold standard, which means that you are going to be wrong 20 to 40% of the time. You are going to be wrong 20 to 40% of the time, and that has to be accepted. And the tragedy is that most people can't accept it. They're emotionally incapable of recording losses of 20 to 40% of their place. It's unfortunate because they could be successful if they just stuck to their guns, but they're so traumatized by these losses, which are inevitable, that they simply fold their chips, fold their cards, and walk out of the room, and they're lost. So let me give you an example. I showed you the top 10 penny mining stocks, right? Let me give you an example of a classic penny mining stock that I own. Why? Here's what you're going to ask. Why penny mining stocks? Why not typical penny stocks any other way? And the reason why is because the incredible advantage that you get in penny mining stocks that are listed on the Canadian Exchange. First, most penny mining stocks are listed on the over-the-counter market, and they're called pink sheets. And they have to qualify for and there are no minimum requirements whatsoever, and they don't even have to publish an annual report. If you are listed either on the Toronto Stock Exchange or the Toronto Stock Venture Exchange, where the juniors are, You have to meet the listing requirements of the exchange. And this is very important. They have to meet the listing requirements of the exchange, which means a lot of the garbage never gets on there. Plus, they have to provide you with an annual report. You cannot analyze successfully a stock unless you receive the annual report, because you don't know what's going on. And all the stocks on the Toronto Stock Exchange and the Toronto Stock Venture Exchange must report annually. So you get this annual report, and so you can make intelligent decisions. Let me give you another reason why. It is a hard asset. When you buy penny mining stocks, you're buying a hard asset. Let me give you a classic example, one of the stocks I own. Gold Standard Ventures, the symbol is GSV, selling at 73 cents a share. Now, I know what you're going to tell me. What? Buy a stock selling at 73 cents a share? I don't think so. Well, let's see what you're getting when you buy a hard asset stock. So the stock is selling for 73 cents a share. There are 277,500 shares listed. And when you analyze the stock, you want to know what the capitalization of the company, of the corporation is. You multiply the price of the stock by the numbers of the shares in existence, and that gives you the total capitalization of the company. That is what the company is worth, lock, stock, and barrel. So the whole company at 73 cents a share, the stock market was giving Gold Standard Ventures at 73 cents a share a total market value of $202,575,000, right? Now, what does Gold Standard Ventures own? 51,000 acres of land. 51,000 acres of land. Now, it's in Nevada, in the desert, but that's where the gold is. Nevada is one of the top gold producing regions in the country, and this stock here is is located right in the heart of it. Now, having established the value of the capitalization, which is $202,575,000, you now divide that by the 51,000 acres that Gold Standard Ventures owns, and you come up that the stock market is valuing each acre of land that it owns at $3,900 an acre. They're valuing every acre that the company owns at $3,900 an acre. You can see that it's a hard asset. It is a hard asset. Any stock, any mining stock that is not in production is a real estate company in drag, because the only thing they own is real estate. When they go into production, then they become a mining company. But as long as they're not in production, they're a real estate company in drag and should be thought of like that. Now, let's take some more how the stock market works in the real world. This is the random walk thesis. And it's critical because if you know what you're doing, this is the way the world works. If you talk to 80% of the economic professors in the world will tell you that the stocks always sell at their true market value because of the efficient market hypothesis, which says that the market is so efficient that a stock is always selling at its intrinsic worth. In other words, if it sells here one day and sells down here the next day and sells up here the third day, it's always selling an intrinsic value. This is bunk. Now, when I was taught this in economics class, I believed every word of it. I believed in the efficient market hypothesis, that stocks always sell at their true value. They just don't. Here's what happens in the real world, and the real world is the random walk thesis. Here's what will happen. This line that you see here is the intrinsic value of the stock. That's what the stock is truly worth. And what you see here is you see that the stock price oscillates endlessly up and down, above and below its intrinsic market value. And you'll see that the spread, the typical market spread, will be plus 15% to minus 15%. And in other words, on a typical stock, there could be a 30% gap between the high and the low. And what happens in the real world? The average speculator is a trend chaser. They only chase stocks that are rising up. So Joe Trend Chaser looks at this stock over here, say, and he sees that it's moving up. So he buys here, or he buys here, or buys here. Then the stock begins to fall, and Joe Trend Chaser freaks out because he has a 10% loss and takes his 10% or 15% loss here. Then the stock goes up again, and as the stock goes up again, another category of losers will buy the stock simply because it's rising in value, and when the stock tanks, they will sell it down here, and then they'll buy it up here and sell it down here. In other words, what you're supposed to do is buy low and sell high. That's what you're supposed to do. But the overwhelming majority of investors will not do that. They buy high and they sell low, and they sell low. That's what they do. They look at the stock market trend, and if it's going up, they will buy. If it's going down, they wouldn't touch it with a 10-foot pole. And you can see that on this pathetic chart that I put up, obviously I flunked art course, that this is what happens in the real world. Now, there's a book that explains this in detail that I'm a strong believer in. It's called A Random Walk Down Wall Street by Burton Malkiel, M-A-L-K-I-E-L. I took down notes of this book because I was so impressed by it. Let me read some of the notes. Mathematicians call a sequence of numbers produced by a random process a random walk. The next move of the stock is completely unpredictable on the basis of what has happened before. The next price change is no more predictable than the flip of a coin. Modern portfolio theory, or MPT as it's called, was invented by Harry Markowitz to reduce portfolio risk in the 1950s. He was awarded a Nobel Prize for his theory, which states that risk can be reduced by investing in masses of stocks that have a negative covariance. In other words, their performance will vary rather than move in lockstep with one another. If you invest in different asset categories, diversification reduces risk. According to MPT theory, the four great non-correlated asset categories are small caps, international stocks, REITs, and gold. Diversification is the premier risk reducer. At 30 stocks, the risk inherent in any one stock, however badly it performs, is very low. And at 50 to 60 stocks, depending on whether you are considering just the U.S. or the U.S. plus global stocks, it has been reduced to the maximum extent that diversification allows. I am fanatical about diversification. The greater the risk you take, the more diversified you have to be. I think I might have told you this, about 123 positions, and I'm fanatical about this diversity because I take a great deal of risk. Let me continue. Einstein called compound interest, which I'm going to discuss also in this course, is the greatest mathematical discovery of all time. Behavior finance states that the efficient market thesis is undermined by four factors. Overconfidence. First is the herd mentality, or what's called today the street sentiment. Second is loss aversion, and this is a biggie. It never ceases to amaze me, the hysterics that people go into when they take a Mickey Mouse loss in the stock market. And you're going to have losses, and it has to be dealt with. Now, the next thing is biased judgments and overconfidence. Overconfidence, it results in investors overtrading their accounts, which is a big no-no. The more you trade, the more you lose. You buy and hold. And being delusional about their ability to predict the performance of their stock picks. And I can't get over how important loss aversion is. Let me give you an example. Every morning, I'm a Starbucks warrior. I'm at Starbucks, and I happen to establish a relationship with another guy who showed up at Starbucks every day, and he was a retired executive in a pharmaceutical company, and he had a $110,000 sports car parked in front of Starbucks. And if you're around me very long, we're going to talk about stocks. So I'm talking to him about stocks, and he became enthusiastic about one of the stocks that I happened to breach to him that sold for 80 cents a share. And I said, look, the most you can ever put in a penny stock is 1% of your investment capital because they're so high risk. And in my the maximum acceptable position is 1%. And my typical position in a penny mining stock is 1/10 of 1% to 1/4 of 1%. But you can put up to 1% if you want to in the stock. So he bought a stock whose name I've long since forgotten, and at 80 cents a share. And about a month later, he came into the Starbucks, and he was upset because the stock had fallen to 40 cents a share. And I said, well, now that it's fallen to 40 cents a share, I'm going to double down on my position, which is something I typically do because I research the stocks and I believe in them and I know what the damn things are worth. If my first investment is $10,000 and the stock crashes, my second investment will be $5,000 and my third investment will be $2,500. So every investment is half what it was before. This works if you are a buy and hold investor, which is what I am. My minimum holding period is 2 years. Let me repeat it again if I haven't already said it. Warren Buffett famously stated that his favorite holding period is forever because forever is what works. What does not work is stampeding in and out of the stock every time it's up or down 10%. That will bankrupt you. So anyway, and as I'm telling this retired pharmaceutical executive that I'm doubling down on my position because the stock fell from 80 cents to 40 cents a share, his eyes are rolling around in his sockets. He's staring at me as if he suddenly dawned on him that I was insane. He left. Didn't see him again until the next couple of months. By this time, the stock had risen from 80 cents a share, from 40 cents a share to $1.20 a share. And when he came in, I says, well, now what do you think of the stock? Dead silence. Dead silence. I dropped the subject immediately because I know what he had done. He'd probably sold the stock as soon as he was in the parking lot, called up his broker and sold it because it dawned on him that I was insane. And this is typical. This is the type of world that you have to understand what it takes to be a success. Now, let me state it again. The book is Super Profits in Cheap Stocks. Wall Street will never discuss cheap stocks. If you go on CNBC or Bloomberg, which are the two financial channels, they will tell you blue chip stocks again and again and again. And that's all they talk about. And to be perfectly precise, they're talking about the Nifty 50. Now, it used to be that the Dow Jones Industrial 30s was the blue chip category. And then they expanded it to the S&P 500, Standard & Poor's 500. These are the 500 blue chip stocks. But as a practical matter, 450 of them you'll never hear about. You will only hear about the Nifty 50, which is the 50 most popular blue chip stocks of the day. That's their world. 50 stocks. You want to know how many stocks there are in the S&P in the New York Stock Exchange? In the New York Stock Exchange, there are 2,800 stocks. 2,800 stocks. Then there's an additional 3,800 stocks in the NASDAQ, an additional 10,000 stocks in the over-the-counter market, for a total of around 16,000 stocks. And these so-called professionals live in a world in which there's only 50 stocks. Brilliant. Just brilliant. Now let me tell you what exists in the Toronto Stock Exchange. In the Senior Stock Exchange, there's 1,561 stocks, which is the senior exchange. Then in the Toronto Venture Exchange, there's 2,424 stocks, and then in total, there's 3,985 stocks. Folks, there's a huge world out there, and it is in the world of the undiscovered cheap stocks that fortunes are to be made. Let me say it again. Let me say it again. The great stock market killings have always been made with cheap stocks that became expensive. Where's the growth coming? From the mighty oak tree, or does it come from the sapling? It is the sapling that has the growth ahead of it. Now, let me introduce you to my favorite category today in mining stocks. It is a special new category that has only come into popularity in the last 10 years or so. It is called the royalty company. Let me read a quick excerpt from my book, which I call The Revolution in Royalties. Here, let me read. I am a big fan of royalty companies, and I have already mentioned them. Historically, royalties in the mining world were a one-off event. They were typically given to a prospector or a small miner when they sold out to a major outfit, usually as a sweetener. It had never occurred to anyone that you could build a profitable business around buying, selling, and creating royalties until Franco-Nevada, symbol FNV, the unchallenged king of the royalty companies, appeared on the scene in 2007. It has been a big winner for me. I bought the stock after the IPO, which is the initial public offering, at around $18 a share, and it's currently selling for about $116 a share. To fully understand the attraction of mining royalty companies, you have to understand the disastrous career of major blue-chip mining companies, if they exist at all. I have touched upon this problem earlier. Big mining companies all suffer from the same curse, the depleting giant ore bodies that made them what they are. Giant ore bodies are few and far between. With a few exceptions, the majors have a disastrous record when it comes to replacing their giant ore bodies at a price that enables them to earn a decent profit. The star performer in the mining world has always been the up-and-coming junior producer that is exploiting new ore bodies with a long future ahead of them. In the corporate world, buying out the juniors has never been a necessity. In the mining world, however, it is an absolute necessity unless you are willing to bet the ranch on new, giant, unproven, high-risk deposits that will cost you the world to develop. The smart money play for the major is to buy out the juniors after they have de-risked their properties. Of course, the juniors are only too willing to be bought out if the price is right. In fact, there are quite a few shrewd junior miner entrepreneurs who are serial players in this game. Why take on the high-cost, high-risk gambles of going into production when you can sell out to a major and let them take the risk? But I am digressing. Let's get back to the subject at hand, the royalty company. The beauty of the new model royalty company invented by Franco-Nevada is that it did an end run around the mining depletion problem, which is the disaster of all companies. They have to replace their depleting reserves. It didn't end the depletion problem, but it shifted the burden of dealing with the consequences of depleting ore bodies onto the shoulders of others. The royalty company makes one big upfront payment when it purchases the royalty, and after that it is never on the hook for another dime for as long as the ore body is in production. In addition, if the royalty is written properly, it has a claim that is superior to that of the mining company that has granted the royalty, because the royalty is attached to the ore body and not to the miner that is producing it. If the miner goes broke and a new producer goes into production, the royalty must still be paid. This new royalty type has become wildly popular in the last 5 or 10 years. Another royalty type that has become wildly popular in the last 5 is called the streaming royalty, which I'm also a big fan in. A streaming royalty is a royalty contract between the royalty company and the miner, in which, in return for a substantial upfront payment, the miner agrees to grant the royalty company a discounted fixed price for the metal produced that is substantially below the current spot price of the metal when the contract was signed. The streaming royalty can also be a percentage discount from the current spot price rather than a fixed discount. Now, you're probably going to be shocked at the type of plays that I go into. If you're not already, you will be. Now, before we go on to my gold and silver plays, a word of warning. If you are not shocked yet about the low, low prices of the stock that I am willing to own, stick around. You are going to be shocked. Shocked. You cannot be serious. You cannot be serious. Buying Ely Gold Royalties at 12 cents a share? I think not. Before you write off these penny mining plays, consider this. And I've already discussed the fact that they're the most highly leveraged, high asset plays on earth, and they have tremendous potential. So let me tell you what the story of Ely Royalties is, because this is the first one I wanted to explain. Ely Gold Royalties, it owns 77 properties, of which 51 have been optioned. In other words, they sell the property on an option contract, usually based on a 4-year option, and if the company keeps paying the option at the end of year 4, they will own the property. Then they retain what's called an NSR, net smelter return, which is a royalty which is permanent. And then they never have to invest another cent in the corporation or the mining firm, and as long as it's in production, every time that it goes to the smelter, they receive the royalty payment. A very sweet deal. And right over here is, if you go to Ely Royalty, let me read here what they got to say on their internet. It says, welcome to Ely Gold Royalties. It's a North American emerging royalty company with producing and development assets focused in Nevada and the western U.S. Its current portfolio includes a number of deeded royalties and option properties, which I've already discussed, which all portfolio properties that they own are up for sale, because what they want to do is sell the property at a profit and retain the royalty. That's what they're interested in. Are sold or optioned on a 100% basis while the company retains the royalty interest. All the company's option properties will produce royalties if the company goes into production. Now, Ely Gold's royalty portfolio includes producing royalties, fully permitted mines, mines under construction, and development projects that are being permitted for mine construction. The company is currently purchasing third-party royalties, so it goes out and purchases royalties to add to its portfolio. The company is well positioned with its current portfolio of over 20 available properties, which is trying to sell, and the company has a proven track record. Blah 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 blah. All right, this is typical. I bought that stock at 12 cents a share. Today it closed at 70 cents a share, and this is a matter of about a year. This is the type of returns that's possible. Now, how much should I put into this? 1/10 of 1% of my investment capital. Let me say it again. The greater the risk, the less you put into it. My maximum potential investment in a penny mining stock is 1% of my investment capital, and my typical investment is 1/10 of 1% to 1/4 of 1%. I'm fanatical about diversification. Let's take a look at another royalty company. This is the king of the royalty companies, which I've just talked about, Franco-Nevada. I bought it at $23 a share. It's selling today at $116 a share. It owns royalties on 374 properties. 112% of these properties are currently in production, so it's receiving a royalty, and the others are it'll be attempting to sell, so it'll sell these properties and then just retain the royalties. It writes the royalties into the land title, and it ranks ahead of the debt holders and survives bankruptcy and ownership charges. Okay? Now let me tell you another okay, so I've discussed 2 gold royalty companies. Now let's take a look at a category that has been absolutely hammered. Absolutely hammered. And that is energy plays. The first play I want to discuss is Earthstone Energy, symbol ESTE. It's selling today at $4.25 a share. 3 years ago, it sold at $15 a share. Now, it is a solidly profitable company. In the last 12 months, it earned $1.37 a share. And yet, And so its PE ratio is 3. Now, PE ratio is a price-to-earnings ratio. This is how the stocks are valued. They're valued based upon how many times the stock is selling times its earnings. And Earthstone Energy is selling at a PE ratio of 3, which is just obscenely low. In other words, it's selling at only 3 times its earnings of $1.37 a share at $4.25 a share. The average S&P 500 stock today sells for 25 times earnings. 25 times earnings. This one here sells for 3 times earnings. Food for thought. Look, what do you get in this energy play? All right. It has operations in Texas. It had in the Eagle Ford Basin of Texas, which is one of Texas's leading oil fields, and in the Permian Basin in West Texas. It has only 14 employees. Its strategy is to buy passive interest in operating wells and gradually become an operator. Its working interest tends to be 4 to 5% of the well. So in other words, they like to own 4 to 5% of a producing well. It owns 20,700 owner-operated acres, which it has a percentage in, plus 14,765 acres of non-operated acres, and 36,520 non-operated acres in the Eagle Ford. That's a lot of terrain for a stock selling for $4.25 a share. Hard assets, hard assets. Let's compare this with the S&P 500. Today, it's had the S&P 500, which are the blue chips, has a historical average dividend historically of about 4%. Trust me, it hasn't seen 4% in mucho years. Today, it is 1.7%. I would spit upon a return like this. Spit upon it. The average PE ratio historically in S&P, like I think I said, was 15. Today, it is 25. Massively overpriced. Massively overpriced. And the historic Shiller PE ratio, it used to be 15, which is a more sophisticated ratio, and today it is 32, the highest in history. Let me give you another energy company that I invest in, Smart Sand. This Smart Sand, in the oil shale deposits, which is where the boom is in the oil industry, you have to have fracking sand to extort the oil from it. And so you need fracking sand. And Smart Sand produces the fracking sand that the shale oil producers need to extract the oil. Now, because of the crash, 3 years ago it was selling at $21 a share. Today it's selling at $1.88 a share. It earned 61 cents a share in the last 12 months for a PE ratio of 2.94. In other words, it's selling at only 2.94 times its earnings. It is a major producer of northern white frac sand in Wisconsin, which is regarded as being superior to the brown sand located in the Texas Basin, and it has a reserve life of 101 years. Okay, let me get on to, I may be running out of time here. Well, let me discuss one of the high-tech. I also invest in high-tech plays. You've all heard about the electronic vehicles and their batteries. The batteries are the key. That's the key. And the electric batteries need 3 things. They need lithium, they need cobalt, and they need graphite. Without these 3 components, the revolution in electronic batteries is kaput. Now, lithium is the lightest metal known to man. If you have a 1 ingot bar of lithium and you throw it in the water, it will float. And if you put a match to it, it'll burst into a flame while it's floating. So you need this cobalt and this graphite to keep it from exploding. Let me give you just one play. I don't know if I'm going to have time to discuss them all. LAC, LAC, Lithium Americas Company, has a 52-week range of between $2.75 a share to $5.88 a share, a PE ratio of 10. It owns 2 world-class lithium projects, one in a joint venture in Argentina in the Lithium Triangle. Most of the world's lithium is produced in South America's Lithium Triangle, and the Thacker Pass project in Nevada, which is hopefully to go into production in the next year or two. So it's got these 2 outstanding lithium projects in the Western Hemisphere, one in Nevada and one in the Lithium Triangle in South America. Now I got 2 more lithium EV plays, but I don't know if I'm going to have time to discuss them because I want to get to income before I run out. Okay, we discussed the random walk thesis, right? Next thesis is income. I'm a great believer in income. Everyone should have 2 portfolios, a growth portfolio and an income portfolio. And since I'm retired, I've been struggling valiantly to get up to 75% income and 25% growth. I'm at about, after years of struggle, I finally reached 70% income place. Now, when I say income, I don't mean a crappy 1%, 2%, or 3%. I mean real income. I tell my friends that I would burn my money before I would accept a dividend return of less than 6%. And I mean it. I would burn the money. Now, as soon as you tell people that, they say, whoa, 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 you must be an idiot. You must be an idiot. Don't you know that any stock that is paying a dividend yield is above 6% is a sucker play because they're going to cut the dividend. They're going to cut the dividend. I wish I had a dime for every time I've heard this because I could buy a new car. I have proven these people wrong. Now, it is true. If the only world you know about is the blue chip world, with a Nifty 50, if you see a Nifty 50 stock that sells for a 6% dividend or higher, then that dividend is probably in jeopardy. But this does not hold true in my world. The world of stocks selling below the 10%, $10 a share that nobody even knows exist. Let me give you the rule that I live my life by in my income plays. It's called the rule of 72. You divide your annual dividend return or your interest into 72, and that tells you how many years it will take for your investment to double. At 1%, it'll take compounded. It takes 72 years for your investment to double. At 2%, it takes 36 years for your investment to double. At 3%, it takes 24 years for your investment to double. At 4%, it takes 18 years for your investment to double. At 5%, it takes 14 years. At 6%, it takes 12 years. At 10%, it takes 7 years. And at 10%, it takes 7 years. And at 12%, it takes 6 years. And at 15%, it takes 4.8 years. Now, I have stocks that pay dividends at 15% and higher. Now, as soon as you tell the classic blue chip investor like this, he goes into total freak-out mode. Total freak-out mode because he's saying the dividends are going to be cut. The dividends, nobody pays dividends like that unless the dividends are in jeopardy. And like I said, in the world of the Nifty 50, the blue chip world, that works. So let me tell you about the world that pays these enormous dividends. It is called the RIC corporations. They don't know that these things even exist. The typical corporation is a C corporation, which means that its income is taxed twice. First, the government taxes the income that the corporation earns, and then when the dividend is paid, you pay a tax on it. So the earnings are taxed twice, and a classic C corporation. But the real kings of the income plays are the RIC companies because under the Regulated Investment Company Act of 1940, Because as long as they pay out 90% of their earnings in dividends, they avoid double taxation. They are not taxed. You only pay the tax. And because they avoid the taxation and because they are required to pay out 90% of their earnings in dividends, they pay enormously. Now, I have 18 income plays, 18 of them, that pay dividends above 6%. Ares Capital pays a dividend of 8.4%. Core Energy pays a dividend of 6.5%. Monroe Capital pays a dividend of 12.5%. New Residential Investments, dividend 11.3%. Oxford Lane Capital, Oxford Lane Capital, 17.8%. PennyMac Mortgage REIT, 8%. Physicians Realty REIT, 4.5%. It paid a dividend of more than 6% when I bought it. What happens is that the stock price goes up, the dividend return goes down, even if the dividend isn't cut. And so my 6% producer is now only producing 4.5% on its return, but it's a fabulous company, and I'm holding on to it. Next one, Aberdeen Income Strategies, dividend 11.8%. Gamco Global Gold, dividend 14.2%. Virtus Total Return, 11.5%. Ladder Capital Corporation, 7.2%. Medical Properties REIT, 4.5%. This is another case where it was 6% when I got it, but as the stock price went up, the dividend return went down, because they always, dividend returns and stock price always go in inverse directions. And Sabine Royalty Trust, 8.2%. Nuveen Credit Strategies, 14.5%. Blackstone Mortgage REIT, 6%. And City Office REIT, 6.6%. Now, I've got a few more here. New York Mortgage REIT, 12.6%. And the biggie, Washington Prime Group, which is a mall, and we all know that every mall in the country is going bankrupt, right? Because of Amazon, 35%. And if we get time, I'm going to discuss why I have a position in this 35% dividend paying. 35%. Now, is it risky? Yeah, but not as risky as people think. And actually, it's so risky that I got typical 0.1% on it because it's so risky. Like I said, on my surest plays, I will go as high as 5%. But the riskier the play, the less of my own money in it. And this is a high-risk play, and I hope we have time to discuss it. All right. Let's talk about the dividend cut. You know, dividends are cut, and I'm sure that people who look at the dividends that I'm receiving say, this guy is insane. He is insane. They're going to cut the dividends, and then the world will come to an end. Guess again. Their world will come to an end, not my world. Of course, you see, I have a strategy. Here's their strategy. They cut the dividend. They go into immediate freak-out mode. Immediate freak-out mode. And sell the stock. Let me go to the chart. So let's see a typical stock that I might own, paying a 12% dividend, okay? Here's the stock price, paying 12%. Then the cut is announced right over here, that they're cutting the dividend, okay? Freak out. Sell, sell, sell. Hysterics. So here's what happens. The next morning, everyone and his brother is selling the stock. So help me, folks. The worst time to sell the stock is the morning after the dividend cut. Do not do this. So the morning after the dividend, they announce the dividend cut at 4:30 in the afternoon after the stock market has stopped trading. Next morning, the hysterics results. You've got a huge bunch of sellers and no buyers. And why do they sell? Because they think they're pulling a fast one. I don't understand this. Half of them believe that God will strike them dead with a lightning bolt if they do not sell the next morning, and the other half think they're pulling a fast one by selling the stock at 9:30 in the morning. You are not pulling a fast one. You are committing an act of stupidity. So you have this huge volume of sell orders at the market, and they're going to crash the stock. So back to the chart. Cuts announced here, 9:30 in the afternoon. Next morning, the stock crashes. In the first frenzied hours of transaction, the stock could fall 20 to 40%. The suckers sell at 9:30 in the morning, and the wise guys show up at 3:30 in the afternoon to potentially buy the stock. Now, here's what they do. What the wise guys are doing is they're seeing, is the stock forming a basing action? And you will see here that a basing action is being formed. So if they see a basing action, they will start buying because they know that the next move is going to be up. There's one more proviso about this. Because the stocks, the high dividend stocks that I pay are RRCs, which mean, there's three types of RRCs. REITs, which are real estate investment trusts, mortgage REITs, and what they call BDCs, business development corporations. All the high dividend properties that I sold you are in those categories. They're either REITs, mortgage REITs, or BDCs, which pay the highest dividends which are allowed because, like I say, they're required to pay out 90% of their earnings in dividends. So there's a very tight correlation between what they earn and potential dividend cut. It's highly correlated. It isn't like the blue chips where you wake up one morning and find out that that General Electric has cut its dividend by 50, 100%, and a company like Heinz Foods cuts a dividend 50 or 100%. So the dividends will typically be only 10 to 15% because earnings and dividends are highly correlated. So here's what I will do. And so like I say, this is what the wise guys show up at 3:30 and they start buying. 2 weeks later, the stock will be somewhere like this. Why? Because everyone who is going to sell is sold out here during this huge 20 to 40% drop. And the wise guys are showing and buying the stock because they know now that this stock is going to rise. So if you want to sell, you don't sell the morning after, you sell 2 weeks after. Now, there's one more proviso here. For all this to work out, the stock has to be selling at least at 6% after the dividend cut. In other words, after the dividend cut, it has to be earning at least 6%. And this is critical for this to work out. And the reason why is because of the desperados. The desperados are retirees who cannot survive on a crappy 1%, 2%, or 3% return. They need at least 6% return to survive. They need high dividend payers. They must have them. So as long as after the dividend cut, the stock is selling at a 6% return or more based on the new dividend, this is what's going to happen. Because now, first of all, the smart money kicks in over here. And after 2 weeks, the desperados arrive on the scene who are desperate for those high dividend payers. So you can have a scenario where 2 weeks later it's here, and 3 to 6 months later it's higher. It's actually higher after the dividend cut than it was before the dividend cut. How much time do I have?
6 minutes.
Okay, 6 minutes. All right, so let me see how if I can continue this. Let me see. Okay. So let me give you a classic example of how this works on page 200. All right, I write about it. It's called my prospect capital fiasco. In 2007, I bought 1,105 shares of Prospect Capital at an average cost of $12.63 a share for a total cost of $13,956. If I knew then what I know now, I never would have bought it. Prospect was a high-paying monthly dividend play, so from day one, I was reinvesting the dividends. You always, always, always reinvest the dividends because the compounding action is critical. You must have it. You must compound. The play was performing well until February 2005 when it cut its monthly dividends from 11 cents a share to 8 cents a share, or a dividend cut of 25%. Cut its dividend 25%. Okay, naturally the stock took a nasty hit. I reviewed my position and incorrectly decided that the reduced dividend was secure, since even the reduced dividend was very, very attractive. I decided to stick with it. Let's take a look at what I mean. After the dividend was cut, the stock crashed to $5.21 a share. $5.21 a share. At that price, it was paying a whopping 19% dividend. And this is classic place on the high dividend payers. After they cut the stock, after they cut the dividend, it'll be selling at a higher price simply because they crashed the stock price. They crashed the stock price. So that at $5.21 a share, the company was paying a 19% dividend. At 19% dividend, you double your money in less than 4 years. It turned out that I was wrong again. In September 2017, it cut the dividend again from 8.3 cents a month to 6 cents a month, a 28% dividend cut. I was not happy. The stock crashed to a new low of $5.51 before it stopped falling. Once again, I analyzed the stock. At $5.51 a share, it was paying a dividend of 13%, and once again, because of the dividend, I decided to stick with the stock. You will notice something very peculiar here. After the second dividend cut, the stock bottomed at a higher price than after the first dividend cut. What is going on here? The answer is the increasing desperation of investors who are trapped into a low-interest world and who cannot survive on the miserable returns that they can earn on safe investments. When they see a double-digit dividend return on the stock that has just cut the dividend, they feel that the new dividend is safe and they pounce. After bottoming at $5.51 a share, Prospect continued to rise. It is currently selling at $6.73. It was when I wrote this. I have just recently, let me continue what I had written. The stock is currently selling at $6.73 a share and paying a dividend of 10.94% a share. The $64,000 question is, how much did I lose on this stock? It must be horrific. After all, I bought the stock at $12.63 a share, and it is now selling at $6.73 a share. I think you might have figured out the correct answer. I didn't lose anything. I have made a profit on the investment. Because of the awesome compounding power of double-digit dividend rates and dollar-cost averaging, which I haven't had a pond, but dollar-cost averaging means as the stock falls, you purchase more, and as the stock rises, you purchase less. So over the holding period, you are accumulating the stock at below its average cost for the holding period. This is critical. Compounding and dollar-cost averaging will make you a killing by the time you're in the third or fourth year. Third or fourth year, you will not believe what this will return for you. So, here's what happened. All right, my original 1,105 shares has exploded to 3,063 shares. 3,063 shares, even though I only purchased 1,105 shares. At today's price, anyway, it was, at the time I wrote this, it was worth $20,614. I finally sold it just a few weeks ago, Prospect. I sold, by that time, there were 3,262 shares that I bought, I sold it at $6.60 a share, and I sold it for $21,530. This is on a stock I bought. What did I buy it at? I told you. Where's the price? At $13,000. I bought the stock at $13,956 a share, and I sold it at $6.60 a share. Quite a profit. This is on a stock that has gotten crushed. Crushed. But this happens only if you play by the rules. Only if you play by the rules, my rules. You don't buy, you hold. You reinvest the dividends, and you keep reinvesting, and you buy and hold. All right. Now, let me tell you how I would play this. Get back here. Let me introduce you to Seeking Alpha. You probably never heard of Seeking Alpha, but I highly recommend it. It's an internet channel in which stock market advisors, both amateur and professional, can write up their concept of what a stock is worth. It's a commentary channel in which professionals and amateurs can write up about the stocks they write and believe in. And I'm on it quite a lot. And there was this guy who purchased Prospect Capital, just like I did, and he purchased the stock, and he's writing on his essay that it was just a terrible, terrible investment. He purchased it on December 31st, 2008, sold it at $11.97, which it wasn't much different from what I did, on October 16, 2019, at $6.49, and he said, I got a total return of minus 54.7%. So as far as he's concerned, he's lost 54.7% on a stock that I have made a handsome profit on. And the reason why is that he didn't compound. No compounding. He was sucking the money out of it. If you don't compound and you don't dollar cost averaging, you lose the power of this concept. You lose the power. All right, let me give you the concept of how I'm going to do it, of how I play my dividend cut. I told you the dividend cuts don't concern me because I got a strategy. And like I said, where I'm playing out in REITs, mortgage REITs, and BDCs, they have to pay out 90% of their income in dividends. So there's very little deviation when the when the dividend is cut. It's usually cut only 5, 10, or 15% because of the tight correlation between earnings and dividends. So anyway, here's what will happen. Say I own a stock paying a 12% dividend, and they announce the cut, and here's what I'll do. 3 strategies. I look at the dividend cut, and I review my holding of the stock, and I make one of 3 decisions. If I decide that I was wrong about the stock, I won't do anything. Here's what I'll do. I'll wait until 2 weeks later and then sell the stock. That's if I decide I'm wrong about it. But what if I decide I really like the stock? I still like it. I review it. Here's what I do. I put in what is called a limit order. Most people don't even know limit orders exist. The typical stock market order is you buy and sell at the market. But a limit order means you buy and sell only if the stock reaches the price that you have selected. Okay? So I will review the stock, and let's say I'm earning 12% on the old dividend. I will pick a price based upon the new dividend that the stock prices, if I decide to hold on to the stock, that is 2% greater than the old dividend. Old dividend is 12%. I will demand a new dividend of 14%. I simply put in the order at a price that if the stock hits it, will be executed, and I will make 14% based on the new dividend. Now, of course, there's some hit here, but how much of a hit here is there? How much of a hit here is there? Not too bad. Not too bad at all. 14%, 12%. You keep reinvesting the dividends, and let dollar cost averaging and compounding work their magic for you. Now, if I really, really like the stock, I will put 2 separate stop-loss orders. One to purchase the stock if it's paying a dividend of 14% on the new price, and another at 16%. Now, if the stock doesn't fall to that price, the order will not be executed. In a couple days, I'll cancel the order. If it is executed, I'm going to be earning 14 to 16% dividend based on the new cut dividend. How sweet is that? I want to thank you people. Here's the stock, super profits in cheap stocks. Learn, this is your chance to make a killing on stocks selling at less than $10 a share. For $9.95, it's listed on Amazon.com, $9.95, you won't regret it. Thank you.